What is a bond? Welcome to our session on the foundations of fixed income. To begin, we must define what a bond actually is. At its core, a bond is a tradable loan agreement between a borrower, known as the issuer, and a lender, known as the investor. When an entity, be it a government, a corporation, or a financial institution, needs to raise significant capital for projects or operations, they sell these contracts to the public. In exchange for the investor's money today, the issuer promises a predetermined schedule of future payments, which typically includes regular interest and the eventual return of the original loan amount. As the diagram illustrates, the bond market acts as a bridge. The investor provides money to the bond issuer. In return, the issuer hands over a bond contract and commits to making future payments. As a trainer, I want you to see a bond as a formal IOU. Unlike a bank loan, which is usually private, a bond is designed to be tradable, meaning the investor can sell that promise of future cash to someone else in the secondary market at any time. The legal framework, the indenture. Every bond is governed by a critical legal document known as the indenture or the trust deed. This is the master contract that describes the bond's form, the issuer's specific obligations, and the investor's legal rights. It specifies all the key terms of the deal, such as the principal value, the interest rate, and the exact maturity date. Because there are often thousands of individual bondholders, a trustee is usually appointed to act in a fiduciary capacity. The trustee's job is to monitor the issuer and ensure they are following the rules laid out in the indenture, effectively acting as a watchdog to protect the rights of the bondholders. Looking at the legal structure, the bond indenture covers two main branches. On one side, it defines the key terms, the principal value, interest rate, and maturity date. On the other side, it establishes the trustee, whose sole purpose is to protect bondholders. As a professional, you must always look at the indenture to understand the rules of the game. It is the ultimate legal authority that determines what happens if an issuer misses a payment or tries to change the terms of the debt. Basic feature 1. Per value. The first basic feature of any bond is its per value, also frequently referred to as the principal, face value, nominal value, or redemption value. This is the specific amount that the issuer agrees to pay back to the bondholder on the day the bond matures. It is important to distinguish this from the market price. While a bond might be bought with a par value of $1,000, its price in the market will fluctuate every day based on interest rates and credit news. However, regardless of where the price goes during the bond's life, the par value remains the fixed anchor, the exact amount that will be redeemed at the end. The table defines par value clearly. It is the principal or face value that is repaid at maturity. As a trainer, I want to emphasize that par value is the basis for all interest calculations. If a bond pays a 5% coupon, that 5% is calculated on the par value, not on the fluctuating market price. Understanding this, nominal value is essential because it represents the actual debt obligation that the issuer must eventually clear from its balance sheet to fulfill its promise to the investors. Understanding price quotes. In the secondary market, bond prices are not quoted in dollars and cents like stocks. Instead, they are quoted as a percentage of par value. This standardized method allows investors to compare bonds of different sizes easily. If a bond is trading at exactly 100% of its face value, we say it is trading at par value. If the price falls below 100, for example to 98, it is trading at a discount. Conversely, if the price rises above 100, say to 102, it is trading at a premium. These fluctuations represent the market's changing view of the bond's value relative to its fixed par redemption. The logic flow shows how we categorize a market price quote. We compare the price to 100. If it is equal to 100, it is at par. If it is less than 100, it is at a discount. And if it is greater than 100, it is at a premium. For you as an analyst, these quotes are the pulse of the market. A bond moving from a premium to a discount tells you that either interest rates are rising or the market is becoming more concerned about the issuer's ability to pay. Basic feature 2. Maturity date. The maturity date is the finish line for a bond. It is the specific future date when the issuer is legally required to repay the principal amount to the investor. On this day, the issuer makes the final payment and their legal obligation to the bondholder officially ceases. Maturities in the fixed income world vary wildly depending on the needs of the borrower. Some instruments are overnight, lasting only one day, while others can stretch for 30 years or more. The maturity date is vital because it determines the duration of your investment and how long your capital will be committed to that specific issuer. The bond lifecycle diagram shows the journey. From the issue date, the bond enters a period of regular interest payments. This continues until the maturity date, marked by the red line, where the principal is repaid and the life cycle ends. As a trainer, I highlight that maturity is the ultimate liquidity event. For a pension fund or an insurance company, matching these maturity dates to their future cash needs is the most important part of their portfolio management strategy. Basic feature 3. Term tenor. Closely related to maturity is the term or tenor. While the maturity date is a fixed point in time, the tenor is a moving target. It is defined as the time remaining until the bond matures. Because time only moves in one direction, the tenor of a bond changes every single day as it gets closer to its final repayment date. Tenor is a critical measure because it indicates exactly how long an investor can expect to continue receiving interest payments. For an analyst, the tenor is the timer that tells you how much longer you are exposed to the risks associated with that particular bond. This simple visual shows that tenor is the bridge between today and the maturity date. As time passes, the today box moves to the right and the red line of the tenor gets shorter. As a trainer, I want you to realize that a 10-year bond only stays a 10-year bond for one day. A year later, it is a 9-year bond. This constant aging of the bond is what drives many of the trading strategies we see in the professional markets as investors move between different tenors to manage their interest rate risk. Market classification by term. To keep the market organized, we classify bonds into two major groups based on their original maturity. Money market securities are those with an original maturity of 1 year or less, such as treasury bills or commercial paper. These are primarily used for short-term liquidity. Capital market securities are those with an original maturity longer than 1 year, which includes the majority of traditional bonds used for long-term projects. We also occasionally see perpetual bonds which have no stated maturity date at all and pay interest indefinitely, though these are quite rare in the modern global landscape. The classification tree splits fixed income securities based on original maturity. If it is 1 year or less, it belongs to the money market. If it is longer than 1 year, it is part of the capital market. And if there is no date, it is a perpetual bond. For you as an investor, this tells you which room of the financial market you are in. The players, the regulations, and the risks in the short-term money market are very different from those in the long-term capital markets. You must know your bonds classification to understand its role in your portfolio. Summary of basic features. To summarize our foundation session, we have seen that a bond is a legally binding contract between a borrower and a lender. This contract, the indenture, is monitored by a trustee to protect your rights. We've defined the par value as the principal to be repaid, the maturity date as the end of the debt's life, and the tenor as the time remaining until that end. Whether it is a short-term money market instrument or a long-term capital market bond, these basic features are the DNA of every fixed income security in the world. Our final summary map brings it all together. Bond basics rest on 3 pillars. The indenture involves the trustee, the par value involves the redemption amount, and the maturity and term involve the tenor or aging of the bond. As a trainer, I hope you leave this session with a clear mental model of how a bond is structured. By mastering these basic features, you now have the foundation to explore more complex topics like interest rate resets, credit spreads, and the engineering of structured financial products. Thank you for your time today.